Good day, everyone. My name is Mary J. Emiliares. My topic is strategic finance and accounting issues. Several finance or accounting concepts central to strategy implementation are acquiring needed capital, developing projected financial statements, preparing financial budgets, and evaluating the worth of a business. Some examples of decisions that may require finance and accounting policies are to raise capital with short-term debt, long-term debt, prepared stock, and common stock. Deciding which of the four is the best way to raise the company's capital, factors like interest rate, earnings per share are needed to consider in making the decision, kaya kailangan ng finance and accounting policy. To lease or buy fixed assets. Dito, kailangan i-consider yung future benefit na magiging decision, and it involves money so it's given na kailangan talaga ng finance and accounting policy, lalo na kung mahal yung asset na pinag-uusapan. To determine an appropriate dividend payout ratio, it also involves money. To use last in, first out or LIFO, first in, first out or FIFO, or a market value accounting approach. It involves the inventory of the company kaya kailangan ng accounting policy sa pag-decide. To extend the time of accounts receivable. Receivables can become a bad debt pag masyadong matagal bago dapat na magbayad ang customer. Pero nakakaakit din ng customer ang medyo mahabang time bago ang due date nila. Kaya making decision about it should be made carefully. To establish a certain percentage discount on accounts within a specified period of time. It also involves money. To determine the amount of cash that should be kept on hand. 5. Special important finance and accounting activities central to strategy implementation. First, acquire needed capital to implement strategies, perform EPS or EBIT analysis. Second, develop projected financial statements to show expected impact of strategies implemented. Third, determine the firm's value in the event of an offer is received. Fourth, decide whether to go public with an initial public offering. Fifth, decide whether to keep cash offshore that was earned offshore. EPS or EBIT analysis addresses the following questions. First, can company obtain the needed capital via stock or debt? Second, would common stock, bank debt, corporate bonds, or some combination be better to raise needed capital? Third, what would the firm's projected EPS values be given securement of capital and implementation of the strategies? Two primary sources of capital are debt and equity. Earnings per share or earnings before interest and taxes analysis is the most widely used technique for determining whether debt, stock, or combination of the two is the best alternative for raising capital to implement strategies. Corporate bonds. Aside from debt and stock, pwede rin itong gamitin to raise capital. Corporate bonds are issued to obtain funds from investors. Convertible bonds are just basically the bonds that can be converted into shares of stock. EPS means earning per share. To get its value, you just need to divide the net income by the number of shares outstanding. Shares outstanding can be also called shares issued. EBIT means earnings before interest and taxes. It is sometimes called operating income. EBT is earnings before tax. EAT is earnings after tax. The purpose of EPS or EBIT analysis is to determine whether all debt, all stock, or some combination of debt and stock yields the highest EPS values for the firm. Inaalam sa analysis na to kung anong pinakamagandang gawin para maka-acquire ng capital based sa kung gaano kataas ang magiging earnings per share pag gumamit ng purong debt, purong stock, o combination ng dalawa. Dahil nga earnings per share ang pinagbabasehan sa analysis na ito, it reflects the maximizing the shareholders' wealth na corporate objective. Dito, makikita nyo sa table 8-4 ang EPS or EBIT analysis for the XYZ company. Makikita dito sa first column yung paggamit ng 100% debt. Sa third and fourth naman ang 100% stock. And 50-50 combination ng stock and debt naman sa last two. As you can see in the table, 100% stock is the best financing alternative as indicated by EPS value of 0.0279 and 0.056. EPS or EBIT chart can be constructed para makita kung kailan nagiging mas attractive ang alternative kesa sa iba. 7 potential limitations of EPS or EBIT analysis. Flexibility is a limitation. As an organization's capital structure changes, so does its flexibility for considering future capital needs. Using all debt or all stock to raise capital in the present may impose fixed obligations, restrictive covenants, or other constraints that could severely reduce firms' ability to raise additional capital in the future. Control is a limitation. When additional stock is issued to finance strategy implementation, ownership and control of enterprise are diluted. This can be a serious concern in today's business environment of hostile takeovers, mergers, and acquisitions. Dilution of ownership could be a problem, and if so, debt could be better than stock regardless of determined EPS values in the analysis. Dilution, ito yung pagbaba ng percentage ng mga dating shareholders dahil sa pag-issue ng bagong shares ng company. Timing is a limitation. If interest rates are expected to rise, then debt could be better than stock regardless of the determined EPS values in the analysis. In times of high stock prices, stock may prove to be the best alternative from both a cost and demand standpoint. Extent leverage is a limitation. If the firm is already too high leverage versus industry average ratios, then stock may be best regardless of determined EPS values in analysis. Businesses with high leverage are considered to be at risk of bankruptcy if they are unable to repay the debt. It could lead to difficulties in getting new lenders in the future. Continuity is a limitation. The analysis assumes stock price, tax rate, and interest rates are constant during all economic conditions. EBIT ranges are a limitation. The estimated EBIT low and high values are estimated based on the prior year, plus the impact of strategies to be implemented. Dividends are a limitation. If EPS values are highest for the all-stock scenario, and if the firm pays dividends, then more funds will leave the firms due to dividends if the all-stock scenario is selected. Here in Table 8-5 is the EPS or EBIT analysis for Boeing Company. You can compute the value of tax rates by dividing the taxes with EBT or earnings before tax. Number of shares by dividing funds needed by stock price plus number of shares outstanding. Here is a demonstration. Tax rate equals 70 divided by 1,000. The answer is 0.07 or 7%. 70 was from the taxes and 1,000 from the EBT. As you can see, the answer matches the given tax rate, which is 7%. Number of shares equals 10,000 over 53 plus 826. The answer is 1,014.68. 10,000 was from the amount needed. $53 was from stock price. And number of shares outstanding, 826. The answer 1014.68 matches the number of shares given in the decision. Projected financial statement analysis. Projected financial statement analysis is a technique that allows an organization to examine the expected results of strategies being implemented. This analysis can be used to forecast the impact of various implementation decisions. Itong analysis na ito ay nagpapakita ng mga expected results na strategies na ini-implement. Most financial institutions requires at least 3 years of projected financial statements whenever a business seeks capital. Here are the 7 steps to explain the projected financial analysis. First, prepare the projected income statement before the balance sheet. Second, use the percentage of sales method to project cost of goods sold and the expense items in the income statement. To get the percentage of sales, you just need to divide expenses by the total sales times 100%. You can see in the table 8-6 is a projected income statement and balance sheet for the Litton company. As example of step number 2, 70 divided by 100 equals 70%. 70% of sales is the cost of goods sold. To project the year 2017, we will use 70%. Third, calculate the projected net income. Fourth, subtract from the net income any dividends to be paid for that year. Para makuha yung retained earnings sa bottom ng balance sheet, you just need to add the retained income computed in the income statement to the retained income from the balance sheet of the prior year. Fifth, project the balance sheet items. Beginning with the retained earnings and then forecasting shareholders' equity, long-term liabilities, current liabilities, total assets, fixed assets, and current assets in that order working from the bottom to the top of the balance sheet. Sixth, use the cash account as the plug figure, that is, use the cash account to make the assets, total the liabilities and net worth. List, commentary, or remarks on the projected statements. Anytime a significant change is made in an item from the prior year to the projected year, an explanation or comment should be provided. Comments or remarks are essential because otherwise changes can be difficult to understand. Step 7 is needed to make the analysis easy to understand. Sarbanes-Oxley Act demands internal controls for financial records and requires the Chief Executive Officer and the Chief Financial Officer to sign statements attesting to the accuracy of financial reports. The Act also increases fines and criminal sentences for fraudulent reporting. Evaluating the worth of a business is central to strategy implementation because numerous strategies are often implemented by acquiring other firms. In addition, sales strategies such as retrenchment and divestiture may result in the sales of division of an organization or of the firm itself. Goodwill is the difference between the amount you bought a company to its actual worth. Nagkakaroon nito pag mas malaki yung binayad mo kaysa sa actual na presyo nito. Discount is the opposite of the goodwill. Pag nakuha mo ng mas mababa, magkakaroon ka ng discount. It can be computed by multiplying the stock price to the number of shares, then subtract the product to the purchase price. There are 4 corporate valuation methods. First is the net worth method, total shareholders' equity less goodwill and intangibles. Second is the net income method, net income times 5. A conservative rule of thumb is to establish a business worth as 5 times the firm's current annual profit. A 5-year average profit level could also be used. In Method 2, pag negative ang income mo, magiging negative din ang result nito. It implies na kailangan mong magbayad o maaaring ikaw pa mismo ang magbayad sa mag-a-acquire o bibili ng company mo. Theoretically, possible to since pag nag-a-acquire ka ng another firm, makukuha mo lahat including the debt and liabilities ng firm na in-acquire mo. Method 3. Price-earning ratio method. Stock price divided by EPS times net income. Method 4. Outstanding shares method. Number of shares outstanding times stock price. You can see here in Table 8-11 is the company's worth analysis for Amazon.com, Restore, and Panera Bread Company. IPOs, cash management, and corporate bonds. Go public with an IPO. IPO or initial public offer is the selling of securities to the public in the primary market. It is the largest source of funds with a long or indefinite maturity for the company. Going public means selling off a percentage of a company to others to raise capital. Consequently, it dilutes the owner's control of the firm. Going public is not recommended for companies with less than 10 million in sales because the initial cost can be too high for the firm to generate sufficient cash flow to make going public worthwhile. You will incur expenses when going public. So when you have a low sales, medyo mahirap punan yung initial cost na kailangan. While sa firms with higher than 10 million na sales, going public can provide a major advantages. It can allow the firms to raise capital to develop new products, build plants, expand, grow, and market products and services more effectively. Keep cash offshore is earned offshore. Dito, earned offshore means kinita ng company from other country. Example, may branch sa Japan yung company mo. Then yung kinita mo doon is earned offshore. In US, many company keeps their money in countries with low tax rates para mababa ang babayaran nilang tax. The US government want to pass a law na kung dadalhin ng mga company ang pera nila sa US, they'll just need to pay once at 10% rate. So the decision to make here is whether to keep the money in the other country or not. Issue corporate bonds for what purpose? Corporations normally issue bonds to raise capital for acquisitions, to refinance debt, and to fund various strategies expected to yield long-term profits. However, increasingly, companies are issuing bonds to buy back their own stock and to pay cash dividends to shareholders. The strategy to make here is whether to issue bonds to raise capital to pacify shareholders with each dividends and purchase company stock, or to issue bonds to finance strategies carefully formulated to yield greater revenues and profits.